Hey guys, what's going on? Jay here. This is smarthelping.com. We're going to talk about contract liability here real quick, and I'm not talking about legal terms. I'm talking about a balance sheet item for accounting, and it stems from a quick write-up here on a stock I've been paying attention to, Rocket Lab USA, and I want to point you to where they're talking about assets and liabilities. So they're saying this company got a solid balance sheet. Um, Current assets of 695 million, current liabilities of 269 million, which is mostly contract liability. So the question is, what does that even mean? Current liability of 269 million, mostly contract liability. So what that is, and I'm just reading the sentence and assuming, but what it normally would be is you've collected cash from customers but you haven't provided the services. So you have a liability because in the amount of the value you've collected that you haven't provided service for yet. It's not a cost necessarily. Like if you have a loan for $100,000, it's a liability. You got to pay $100,000 back. But if you have a contract liability, typically, this is called something like unearned revenue. Um, the liabilities for the amount that you've collected that haven't provided service for, it's not for your cost of the service. Um, and anyway, I've put this in two financial models that I've built in the past. I might have it more, but the two that come to mind the most would be, I'm going to show you guys in the models. Let's look at the first one, a made-to-order manufacturing business right here. And I'll play with the model a little bit so you can kind of see how this works. I build financial models for a living, a three-statement modeling integration. So if we go to the balance sheet, you can see this unearned revenue item here. So all that's saying is we've collected this amount of cash up to this point where we haven't yet provided service. Now in this model, it's going to be a function of this shipping and the amount of orders. And I can show you, let me just zero out all of these items here. So let's say we're looking at unit type 1, $80,000, and we're saying let's say one item is ordered from a customer in month 1, and we collect 50% of this 80,000 in month 1 and 50% of the 80,000 in month 5. Now, everything's triggered off of the order month, which would be right here, month number 1 in this case. And we're saying the unit ships in 3 months after the order happens. So there's going to be a time when you have unearned revenue, and then this actually will also go to accounts receivable because you're not collecting the final half until 5 months after the order, but you're shipping it in month 3. So if we go to our balance sheet in this case, we should see 40,000. Yep, there it is. 40,000 in unearned revenue, 40,000 unearned revenue. And then it goes away in month 3 because we've shipped it, but we haven't collected all the cash yet. So if we go up top here, you can see there's accounts receivable of the last 40, and then finally in month 5 we ship it. And then if we go over to our income statement, you can see we're recognizing the revenue when the unit ships. So the whole 80,000 here is shipped in month 3. So that's when it's recognized. And we've got some cost of goods sold here that are also recognized when the unit ships. But that's one model that has this idea of contract liability. You can configure this however you want. This could be maybe 80% up front, 20%. And now if you collected it in month 3, the remaining 20%, now there is no accounts receivable. You have your unearned revenue of 64,000, that's 80%. And you're recognizing the 80,000 is still in month 3. So, and you can scale this across 10, in this model, 10 different SKUs or products that have different order volumes over time, over a 2-year or 10-year period. And you can configure this pattern of cash collections and when the order shifts from when it's actually sold, and all these pricing over time. So this is a pretty good model for figuring this out at scale and seeing the cash flow effects. You can see the cash flow statement. We have, oh, let me see, earned revenue 100,000 just because I have ancillary income. Let me zero that out. So we have 80,000, but we're zeroing out the increase in AR. But we have cash collected. When's this cash actually collected? Here, customer payments, and some is collected here. So this is the actual cash coming in, and you zero out the earned revenue and reduction of AR. Those balance out, and that gets you the correct cash flow in each period. All right, so that's one model that explains this concept. I want to look at a second, and it's a SaaS model. And this one, by the way, you can buy all these templates on the site at smarthelping.com. Got over 200 unique financial models. Where am I looking here? Enterprise SaaS for in contract length. So when I built this model, that's loading up, it has an option to collect all the cash receipts from a contract up front or not. So if I were to hit yes on this box, go to the balance sheet, look, I have this unearned revenue happening. Now this is a little bit different because we're saying that these are recurring contracts, and whenever there's a new customer, they pay all of the money, 100% of the whole contract value up front. So that's this 350,000. These are average contract length 6 months. This full 350 is all going to come in first month of the customer joining, however many customers join. Now, if I clear out these, I might be able to show you, might be easier to see. Let's say there's just one customer. Let me see if that allows you to get an idea. So unearned revenue 875. It's cash flow. So this is based on, let's look at how many new customers are coming in. 3. So 3 customers, and there might be a decimal here. Nope, it's just 3. So those 3 are all paying 350,000 times 3. That's 1,050,000. Now we're recognizing these are over 6-month contracts, so we're recognizing this amount in month 1 and 2 and 3 all the way through to month 6. So if we subtract them out, you've got 875, which I believe is the number you see here. Yep. So that's the unearned revenue at the end of month 1. Then as you collect the money from that contract, this starts to change. Now keep in mind we're also adding customers. If I were to, let's just make it super easy. Make this 1 and make this 0. And let's zero out the ad spend as well for these other tiers, just so I can demonstrate the point I want to make. Okay. So your unearned revenue is 290, which again, I cut it down to one customer. So this is now just that. So 291, and then the next month it would be, 233. So you get the point. It's going down to 0, and then you sign up a new customer, and then they do the same thing. Now, let me see my customer feed here. We've got 1, and then there's a little bit less because there's a chance that they don't renew. So there's some logic here saying, we lose 20% that potential client existing. So your unearned revenue is a little bit less than over here. And then that goes to 0 and so on, and you keep doing that. And that's the pattern that happens over and over and over as new customers are added. There's quite a lot of logic to figure out what this number is over time based on all the different things that can happen with your customer ramping, but this model does a great job at showing that effect in detail. So you can see here we've got the earned revenue happening up top. We're reducing that out here, and then we're actually putting upfront cash collection. So you see 350, 280, 210. That's the actual cash coming in So those are just two different financial models that use this concept of it's a contract liability. Technically, the accounting term for it is normally unearned revenue. And I thought that's an interesting point to touch on. If you guys want more financial models, go to smarthelping.com, check out the financial models tab here. I've got hundreds. You can buy everything I've ever built if you want to click on that super smart bundle at the top. 500 bucks will get you all the financial models I have on the whole site, or you can find the perfect one for you. Uh, just check them out. You can buy them individually. A lot of logic here, a lot of time and intellectual power has gone into building these things. So there's a lot to learn, a lot to use as well. Alrighty, like and subscribe, and hopefully that's a nice tutorial on unearned revenue and financial statements. It affects the income statement, balance sheet, and cash flow statement. Alrighty, take it easy.